welcome to our pre-budget series, What the World Wants from India. Foreign investors closely watch India's budget as a consolidated and high-profile statement of the government's reform initiatives. The current budget comes at a time when smart money globally has been selling emerging markets and buying developed market equities, especially like the US. Will this trend continue in 2017? Will the tide turn towards emerging markets? What will be the pecking order within emerging markets, and what will be foreign investors looking for in the Indian budget? For all these questions, I am joined by Lucy MacDonald, Portfolio Manager and Chief Investment Officer at Global Equities at Allianz Global Investors. Thereafter, we will be speaking with Brian Jacobsen of Wells Fargo. But first, let me welcome Lucy MacDonald of Allianz. Lucy,
Hi.
Thank you very much for joining us today.
Delighted.
Well, first up, this overarching trend that we have seen in the last quarter of 2016 of selling emerging market equities and preferring developed market equities, does that trend continue in the first quarter of 2017 as well?
The performance of emerging markets versus developed is very correlated to the dollar, as you know. And the strength of the dollar post the US election did lead to quite a sell-off and outflows from emerging markets. Now, that seems to have slowed in the early part of this year. And although we think there's still medium-term upward pressure on the dollar from rising interest rates, the positioning was so strong in favour of the dollar at the end of the year, it's not surprising that there's a bit of a sell-off. So I think from where we stand now, emerging markets have clearly sold off to more attractive levels. Profits have been taken from the strong performance of the whole of last year. So valuations are now looking more interesting again.
Within the emerging markets, what's the pecking order?
Well, we do prefer Asia. And there we think that the strong growth that we're seeing at the moment should come through because of the export nature of those markets. So that's our first area of looking. We think the commodity markets have had quite a good run, and do have other issues that make us slightly concerned. So Asia is preferred from a valuation point of view, and also as a beneficiary of global growth.
Well, as you pointed out, it is the commodity manufacturers who benefited in 2016 within the emerging market pack. Will that continue, this pro-commodity run, and therefore the preference for commodity producers within emerging markets?
There still looks to be some potential momentum within that sector, which can continue into this year. But really, in the medium term, those aren't the companies that we really think have got the more interesting growth potential.
Okay. Well, where does India figure? We did see an underperformance from India post-November 8. Actually, that date coincided, the Trump victory coincided with India going through a major currency swap or a demonetization program. Does the Indian underperformance end at all? Do you see India outperforming emerging markets in the first quarter of 2017?
There is a potential for India certainly to stabilise its performance, and from the evidence that we have from inside India, but also from the companies that we invest in who are operating in India, it does seem like the effect of demonetisation is beginning to wane. That suggests that if that was the main reason for the underperformance, then that should be losing its importance.
What will you look forward to from the Indian government in general and the budget in particular, if at all?
The impact of demonetisation on tax receipts, and then also looking to see whether any of that is funding tax cuts on the other side. So that's what we'll be looking at, to see the overall impact on tax receipts and on policy going forward.
What's your view on the Indian growth, either GDP or the earnings growth? Do you see it much better in FY18? What are the numbers that you're working with?
Well, we don't have specific forecasts for the GDP growth, but it does look like it should be stabilising from here, from that negative impact.
Okay. Is there any specific sector that interests you? The technology sector and the drug sector, pharmaceuticals are pretty much dependent on export markets. Would you prefer those, or would you prefer cyclically oriented companies that depend on the India growth story?
Well, I think at the moment I would be a bit more cautious about the exporters. While we see what the Trump administration is going to bring in terms of border taxes and also in terms of immigration reform. And I think as far as the Indian IT sector in particular, it's clearly benefited a lot from outsourcing over the last 20 years. And from everything that we hear at the moment, although we have no firm facts, but everything that we hear at the moment, it looks as if that is going to be curtailed to some extent. Plus the free movement of people, within, in and out of the US could be more, could have more barriers. So I think from that perspective, I think I would be slightly more cautious at the moment and just waiting to see how those issues develop. That is slightly less the case in pharmaceuticals, although any import tariffs in the US could clearly be an issue. So on balance, I think looking to where you can have some domestic growth potential without having those concerns at the moment could be a better place to be.
Well, it is a possibility that in the forthcoming budget, gains from Indian equities are taxed a little more. Capital gains are taxed a little more. Will that be a deterrent? Will that put you off?
In the long term, no. In the short term, possibly. I think from our experience elsewhere that the capital gains tax is not the primary determinant of markets and how they behave. On the margin tax impacts, but really it's much more to do with valuation, with earnings growth, and with any improvements in quality, which reform is part of that in India.
Mm-hmm. Well, there is a chance that India doesn't adhere to bringing down its fiscal deficit from the current 3.5% to GDP, 3.5% of GDP to probably 3%. Maybe it sticks with 3.5% or 3.4%. Will that be a very big put-off?
I would think not, because fiscal austerity elsewhere in the world is going slightly out of fashion. And so I think, we've seen in Europe that the fiscal constraints are being loosened out of necessity to drive some growth. That, although there is talk about constraining budgets in the US and the UK, we've really seen the opposite. So I think between the numbers we're talking about in India, really in a global context, do not look out of control.
Well, fair point. Well, let me just get a couple of more questions on the global context. Do you expect the dollar to strengthen after this current sell-off that we have seen? For instance, the dollar index selling off from 103 to 100. How would you look at the dollar, say, over the next 6 months? Does the index go to 108, 110?
Yeah, it does look as if directionally there is upward pressure on the dollar still from the Fed and the movements in the Feds that we're expecting, which will be the response to the stronger growth that we're seeing and slightly higher inflation, which enables them to get back to a normal level of rates that they've been wanting to do. So that, we think on balance will mean that there's upward pressure on the dollar still, and positioning is not as extreme now as it was at the end of the year.
Okay. What about the Indian rupee? Does it worry you as a currency that might see depreciation?
From these levels, less so, and I think it's going to be much more a question of the dollar against everything else, rather than specific currencies.
Fair point. Lucy MacDonald, it was a pleasure speaking with you. Thank you very much for joining us.
Thank you.